You guys started de-risking a year ago. You started building up the cash allocation over the 12 months. I would have thought last week was just a great opportunity for you guys to get back in. If you did, what were you looking at?
We were looking at big dislocations that we saw. We're seeing some dislocations in shorter dated corporate bonds. So we've been, those have been widening out recently as people use those for liquidity. And that's where we've been allocating our capital. Shorter dated bonds, spreads are wider, anywhere from 20, 30 basis points compared to a couple of weeks ago. These are very safe bonds. You hold them for a couple of years. They're unlikely to default. While we don't expect a recession anytime in the next 12 months, there's likely to be one over the next 2 or 3 years. So we're staying liquid, we're staying shorter dated, and that's where we've been deploying much of our capital over the last couple of weeks.
Stephen, do you like that? Stay liquid, stay shorter dated. Does that make sense to you?
I think you want to be a little bit more opportunistic. I mean, last year was, by many accounts, the least volatile year in history for equity markets.
Right.
Clearly, that's not going to repeat itself. So I think our view, no recession in the next 12 to 18 months, so weakness is a buying opportunity. Last week for clients, we were buying. We were moving into U.S. equities broadly, more opportunistically into emerging markets. So, yeah, I think you have to be ready to be a little bit more tactical and opportunistic, but our view is that this is still an earnings-driven market, and that's a good thing given what we're looking at for the
John,
year.
what's your view? Because the view from most of the people I speak to on the street, the big equity strategists from the main banks on Wall Street, is say, stay fully invested. That's the message I've heard again and again and again for several months. It feels stupid to be in cash, was the line we all heard about a month ago. Why does it make sense to have a cash allocation now?
Well, we would say it makes sense to have a cash allocation relative to your fixed income position. But relative to equities, we can continue to say you want to be long stocks that expose you to the cycle. You want to be light on defensive stocks right now. Many of those are bond proxies.
Yeah.
And in addition to that, we even suggest looking at smalls and mids because they've been so disfavored. They were hurt the most in the pullback. And we can't help but think as the economy continues to grind higher and likely with tax reform gets a boost. The other thing is, as you see the normalization process take place, what's occurring at the same time is tax reform is providing liquidity to corporations. So there's a big offset in that for many companies.